Hi there, Jim Small again. I want to talk to you in this short clip about the difference of the taxes you'll pay when you invest in the U.S. in two different scenarios. First, we're going to talk about a pure equity scenario. That's where you're taking cash and buying a piece of real estate and later selling it. The second scenario we're going to talk about is where you take the same amount of cash and you become a private lender on real estate in the U.S. Let's look at some of the tax implications. Now, take for example a $100,000 equity investment. Let's say you make 7% per year from rent income and profits. So that's going to be about $7,000. And let's say you do that for 5 years. So that means you're going to end up with $35,000 of income or taxable income in the U.S. Now later you're going to sell this asset. Clearly at some point in the future you'll probably sell. Let's just say that's also 5 years later and you sell your $100,000 asset for, I don't know, maybe $110,000. You then sell the asset, so we'll add that into this amount. You sell it for $110,000 and it's going to have a certain tax rate as well. Now, you don't get taxed on your original investment in the U.S., and I don't think in most places. So you're really taxed on the $35,000 of income you got over the 5 years, plus this $10,000. Now in the U.S., you're going to be taxed at approximately a 15% tax rate here, and probably about, if things hold true now, 25 to 30% here. So let's just say what that is. Let's just go with more conservative 25%. Now if that holds true, that means on the $10,000 you're paying 15% or the equivalent of about $1,500 in tax. And on 25% of 35,000, that's about 10.5 if my math is correct. So you're paying 10,500 or a total of $12,000 in taxes in the U.S. Now, remember, you made money, so that's okay. You made $35,000 and you made $10,000. So out of $45,000 total, that's the gain. You gained $45,000 before tax, and then you took away $12,000, so you ended up with $33,000 at the end of the day. Not bad, 5-year investment, got your capital back, that's fine. Let's take the other scenario where you have a private loan. And let's say, like some of our deals, you're actually getting 8%, let's say 8.5%, because that's the current rate we pay. So you're getting $8,500 per year by lending on U.S. real estate. And let's say again that goes for 5 years. And so over 5 years, it's that 42.5 is your gain. Now you don't own the property, so you didn't get the appreciation. You didn't get that extra $10,000. So you just get back your $100,000 and you're left with the 42.5. Now here's the interesting part in the U.S. If the deal is structured properly with the right terms in your promissory note and the right structure, you actually, as a non-American, will pay 0 taxes. You will not be part of the U.S. tax code and will not pay taxes on this $42,500 because it's portfolio interest. So times a 0% rate, yep, you're still left over with $42,000, and obviously that's more than the $33,000 in the equity. But here's the best part. You didn't become part of the U.S. tax code. You didn't get an international tax ID number or their social security number or file taxes or any of those expenses that I did not include over here. And not only do you have a larger gain, but you also have less risk. See, in the equity investment, you bought a property, it could have gone down in value, could have been destroyed, etc., and your whole investment would have gone away. In the scenario where you're a lender, you actually are going to get paid before whoever the owner of the property is. In the case of our investments, our company's the owner and our private lenders get paid back first. So you end up with a much higher profit, you don't pay taxes, and you have less risk using the portfolio interest method of investing in U.S. real estate.